Welcome to the Energy Desk, a limited series from Mobius Risk Group on the macro and fundamental trends shaping global energy markets. If you like what you hear and you want us to keep this series going, make sure you let us know by following wherever you get your podcasts or dropping a note to Melvin@mobiusriskgroup.com. Let's hop in. How's it going, Zane?
Good.
We are in our third installation of the Energy Desk. It's been a lot of fun to chat with you here.
Yeah, you too. I like the idea of installation rather than installment. It feels far more permanent than installment.
Exactly. Yeah, so we got some good stuff today. We got a bunch of things happening all over the world, hurricanes, economic shifts. So where do you want to kick it off today?
Well, you wrote a piece on Sunday that I think is an interesting starting point, going back and looking at a very long history on what recessionary periods have meant for product demand. So why don't you start with just a recap of what you put out in that very thorough piece, and I'm sure I'll have a question or two.
Yeah. So this was an interesting kind of question that I had because over the last several weeks, several months, we've been looking at a lot of these economic indicators, twos, tens, inverting in 2022, now, disinverted in late August, early September. And so that's the longest period of twos, tens inversion on record. And that has historically, since at least 1955, pointed to incoming recessions. And so that commentary seems to get a lot of coverage. But the question that I had was, all right, what is the real impact on commodities? And specifically in this case, what's the impact on petroleum consumption? And so that was kind of where the question started. And when we look at just ember-based recessions, we've had approximately 11 recessions since January of 1950, and when we're looking at monthly data. And on average, that's about 10 months, median about 10 months. And so using EIA data, we're able to pull a bunch of stuff and really look at, all right, what's the impact on per capita consumption in the US when we have recessions? And so the first, 25-ish years between 1950 and 1975, we see a little bit of a transient impact on per capita, both gasoline and distillate demand. When it gets really interesting, though, is after 1975 and really the 1979 oil crisis, where we have a bunch of variables coming together. We have double-digit inflation. We have interest rate hikes to target that inflation. And then we have the Middle East oil crisis situation that then drives crude prices basically up 148% year over year. And that year really kicked off a period where each subsequent recession has had pretty dramatic impacts, at least statistically, on U.S. consumption of refined products. And so when we look at 1979 to 1983, this kind of 4-year period where we have so much inflation, we have a whole lot of economic, trends that are double dip recession. You have interest rate hikes, a lot of layoffs, things like that. And gasoline consumption in May of 1980 drops basically 9% year over year when we're looking at per capita rates. And then same for distillate. We're dropping basically 15% year over year. And that was the largest until 2020. But I think it's really just quite interesting to say, all right, between the 4 recessions after that 1983 period, what was the impact for distillate demand? We have in the 1990-1991 recession, minus 8.99%, 2001, 2002, minus 5.5%, 2007, 2009, minus 10%. Gasoline demand per capita rates, those changed a little bit less, ranging anywhere from about 1% to 4.5%. But I think really the interesting takeaway that I had from this research was, the historical recessions, that's all great. But the June 2024 per capita distillate consumption, when we're looking at that 12-month average, that actually sank to its lowest since 1966. And I think that's kind of an interesting
clarifying point there.
Yeah.
12-month average, what you mean there is a rolling 12-month average, correct? So we're not
correct
using one single data point and trying to smooth the data to say, is there a trend here? So anybody listening, when he says 12-month average, we're talking about a meaningful period of time that should capture, or I guess maybe better said, should eliminate any one-off anomalies in a month in the set.
Exactly.
Sorry.
Exactly.
Back to you.
No. Yeah, that's good. That's good clarification. So again, 12-month trailing average. So the moving average of U.S. per capita distillate demand in June using EIA reported data sank to its lowest since 1966. And when we look at the year-over-year percent change of that, that is minus 4.42%. So, very similar trend to what we saw, 2020 levels and several times kind of all throughout post, I guess, 2000 era. And just kind of, it opened a question for me, what does that mean for distillate demand? What does that mean for gasoline consumption, things like that? Well, for distillate side, very closely connected to industrial activity, as we've discussed, at length in our chats. We have basically a over 2 year period where we've had kind of struggling sector where we're, ISM manufacturing indicators, all of those are sub 50, so indicating contraction off and on for basically the last 2 years. And on the gasoline side, why are we seeing negative year-over-year changes in gasoline consumption right now? Taking away recession risks, I think really the takeaway that I had was the fuel economy of the U.S. light-duty passenger fleet, which, again, any listeners, this is quite a bit of data. So we're going to be putting all these chart decks in a link for you guys. But average fuel economy of the U.S. light-duty passenger fleet since 2005, when per capita consumption really started to fall off the map, that's gone up almost 34%. So it's a pretty incredible change for efficiency. And I think that we're potentially seeing some of that combine with some of the economic data that is emerging in the last couple months here. So that was a lot of information, but kind of an interesting.
I think there's a couple other interesting things just in what you shared for people to go back and contemplate. One of your starting points and one of the most severe declines was in the late 70s, early 80s, and tying that to the present and why might it be relevant. Of course, that was the formation of the events that led to the formation of our SPR, our Strategic Petroleum Reserve. And so, we're in a world where it's in some ways us versus OPEC, us meaning the US, but maybe you could broaden that and say the North American crude producing, refining, exporting fleet. Because there's another one to me that's kind of interesting in there, just in more recent history. And I think fitting what you're talking about with the declining per capita consumption, our product exports just in the recent history, if you go back to 2019, which is often a reference point for where we are presently in global crude markets, but stick in the micro of what's going on in North America. In 2019, from the beginning of the year through early September, product exports were 5.1 million barrels a day. Last year, that was up to 6.2 million barrels per day over that same period. And then in a very short 1 year time frame, so increased 1.1 million barrels a day over a 4-year period, certainly as Alex pointed out, in the 2020-2021 conundrum. There were some dips, but here we are presently, and U.S. product exports year to date are 6.6 million barrels a day. So what we're saying is we don't want it. Rest of the world, you take it. Mm-hmm. And I think that becomes an interesting concept in the context of per capita consumption. Probably for a subsequent podcast. Alex has done a lot of really great work on India and China and, really in general, more the India-centric sort of nations. Maybe that's not fair. Vietnam or other Southeast nations.
Yeah, Southeast Asia at large, yeah.
I mean, they don't really want to be called India-centric, so I apologize, other nations. However, the idea that per capita consumption in these places has yet to see the parabolic increases that I think Alex's work says we could very well see in the near term. And we're saying we don't want it, so you take it. But in the very present world that we live in, as Alex pointed out, the longest period of contraction level numbers from US PMI data, the constant barrage of headlines from China that say demand is not what it once was, then you're clearly not looking at Europe, where Germany's track record, and in some ways was covered in last week's discussion around the power sector in Germany, industrial activity in Germany. Mm-hmm. But it's not Europe. They don't want it. China doesn't seem to want it, at least right now. And so you're looking to parts of the world that are in a lot of ways kind of unknown. Like, how much would they take, and how consistently will they take it? My personal view is that we are decidedly in a world where there is plenty of crude. It's not certain yet whether there can and will be enough product. But what we do seem to know, at least for the near future, and I'll define that as next 6 to 18 months, is it's not us, meaning it's not North America, it's not Europe, and it's probably not China. So how much do they want? I think it's a really interesting time. Not only like where will it go, but how will it get there?
Yeah.
How much more product can we supply? And then you've got a shipping fleet that is trying to find creative ways to not use bunker, whether that be LNG fueled fleets, even the ammonia fueled fleet. I don't know. To me, that feels in some way Back to the Future, like put some banana peels in the flux capacitor, but maybe spent billions of dollars on it. So I imagine someone solved the riddle, and then, I think the next thing that becomes interesting with that per capita consumption falling is how many people will there be in the world? At the end of the day, It's all about absolute demand levels, without getting too far afield. Where's the population growth, and at what rate will it grow? And then in respect to industrial activity, like you pointed out, there's a high correlation between industrial activity and distillate demand. I'm a bit of a caveman approach, but I think of the shift away from coal. If anybody's ever done their own site visit, done their own snooping around the internet curiosity, when you see the size of the dump trucks that get used at coal mines, it's hard to even call it a dump truck. It's like earth mover.
Exactly.
You imagine that thing uses a bit more fuel than your typical 18-wheeler that you see rolling down I-10.
Yeah. Just the scale of industrial activity is hard to comprehend for sure. Yeah. A couple of notes, just, other context points for listeners, talking about per capita consumption and how that is regionally different. With the U.S. conversation, we're in 2023, at least, total per capita petroleum consumption was about 20.7 barrels of oil per year per capita. That's down from 2000 over 25 barrels for the US. And for the EU, just as you were mentioning with Germany, the EU has fallen from about 12, 13 to 8.5 in 2023. So Western led, that's not going to be, the big driver. Conversely, you're looking at a place like India, 1.45 billion people, they're consuming, 0.8 to 1.1 barrels per capita per year. So there's quite a bit of growth that we, you can see the potential for what that can be, but it's just, I guess, determining what's the consumption activity in India, for example. In China, one of the interesting things that came out today is they raised their retirement age because they have this top-weighted population, a lot of risk to China's economy there. But I think that's another one where you extend your working age population. Maybe that adds a little bit of something for Chinese demand. So there's some of these variables that, especially in the Asian markets, kind of make it a little bit more interesting. But we don't need to really get into the weeds on that.
We should keep these podcasts like a half a day long. I'm sure we'll get people to stick around long enough.
Yeah. But, kind of sticking on this side of the world, we had some interesting stuff going on in the Gulf of Mexico this week. And I'm curious to get your thoughts with Hurricane Francine and some of the thoughts, I guess, around hurricane season in the Atlantic and some things that we should think about.
Sure. I would say to begin with, we've got arguably a month left in the 2024 hurricane season. They can come a little outside that window, but in general, we are at the peak. This is when it's supposed to get heated. And I guess you could say for the most part, it is heating up. We just had a decent sized storm roll through the Gulf. And I think they are relevant in that hurricanes are no longer a bullish driver in like the classic sense of I lose Gulf supply, and that is a near-term bullish factor for crude and gas markets. So we'll start with the crude market. This week's event. So Tropical Storm 6, which became Tropical Storm Francine and eventually Hurricane Francine, spawns in the the far southern Gulf of Mexico, say southwestern Gulf of Mexico, kind of off the western side of the Yucatan Peninsula. And the first thing in the way, while it doesn't really get covered, is Mexican oil infrastructure. So there's quite a bit of Pemex infrastructure in that area. And honestly, I didn't really even see a whole lot of news about that, while there actually may have been some damage. But next in line, one of the biggest facilities as you start moving up the Mexican coastline and towards the Texas Gulf Coast is the Shell Perdido platform. It's a newer vintage floating platform. It's worthy of go watch the YouTube video on its installation on its own. So the original track was headed straight for Corpus, and that was as of Friday, September 6th. And certainly that Shell Perdido platform was in the way. So you start to shut in some production, but had it stayed on its original track, it would have headed right for the port in the U.S. where most crude barrels are sent out to the global market. For context, we export, certainly some weeks will still fall down to 3.5 million barrels, but in general, we export 4 million barrels a day of crude from the U.S., 4.2. 2.5 and change are going to get sent out from the port of Corpus, not really the port of Corpus, but that area, Ingleside and Corpus Christi, more from Ingleside than Corpus. It's a little closer to the open water, that being Ingleside. And so what we don't know is how that would impact crude exports if a large storm truly headed squarely into that area. While Harvey, flirted with it and certainly was bouncing along the coastline in that area, we've seen significant increase in crude exports since Harvey was down there. And had Hurricane Francine gone in there and done anything even moderate in terms of damage, let's just say had enough of a tidal surge that you brought enough sandy bottom and, impacted the depth at which, or the draft of the ships that could move through that area. You lay a crane down, you flip a barge over and sink it. That was one of the issues when Hurricane Laura in 2020 went through the LNG corridor and I'll call it the Sabine River Delta. You sunk a barge, and it took quite a while to get all the powers that be to say all clear. First, get the barge up, ensure that there wasn't something spilled that needed remediation. And so when you think about Gulf production, Gulf oil production, 1 to 2 million barrels a day, and you got more than that exported out of a single port. So hurricanes heading to Corpus can certainly have a bearish impact in the near term on crude. Narrow miss this week. And then, I think the gas market has, become very aware of that shift from tropical storms in the Gulf being bullish once upon a time, call that pre-shale era, to now a considerably bearish event. Gulf natural gas production, 2.2, 2.7 BCF a day out of 104 BCF a day, pick your day, whereas the pricing environment, if I turn off that production, okay, I lost some supply maybe for a little bit, but relative to that Sabine Delta, where there's 8 to 9 BCF a day of exporting capacity, you turn off the ability to get those MMBTUs on the water, the market's got a very acute near-term problem. And both of those, the problem becomes acute because of the amount of storage capacity that's available. Crude itself is a far easier to store commodity. It's a nice, convenient, relatively stable liquid. You could put it in your swimming pool if you needed to. Natural gas, on the other hand, highly volatile, must be contained, doesn't do well in the open air. I'd like to see somebody try to put some natural gas in their swimming pool. I think the important piece to take away with the facts laid out here is that over the next month, tropical activity in the Gulf of Mexico should be understood for its bullish and bearish impacts, noting that the bullish ones are incredibly acute and the bullish ones are meaningful, however, probably pretty short in duration, such as this week. Any of the platforms that had been shut in, there's a bunch of helicopters and crew boats and supply boats heading back out to get the boys up and running. It's time to get it going again. I mean, one thing we know for certain is we have to get our barrels on the water. We don't want them. Kind of where we started the conversation today.
Right.
Virtually every barrel of U.S. crude production since we began exporting in 2014 is headed to somewhere else. And as we covered early in the podcast today, 1.5 million barrels a day more product is exported this year than was over the same period just a few years ago in 2019. So we're giving it somewhere else. And if we do not have the ability for, in the near term, meaning for say a 5 to 10 day period, to send it to someone else, what do we do with it? In that for both, I think crude and gas just becomes increasingly bearish over time. In the near term, we've got the Plaquemines facility that was squarely in the path of Francine. I guess thankful for the gas market, the one facility that's next up suffered the most direct hit, while we haven't heard news of any substantial impacts that would delay its in-service. Those could come out in the coming days. And then, as you move forward over the next few years, you should see at least another 4 BCF a day, maybe another 6 exported out of U.S. terminals. And so that just shifts the skew, more and more exports while production is stagnant. And while we're likely still another 18 months, maybe 24 months away from a step change in oil exports, we'll get it. Otherwise, we'll have to price off any incremental U.S. production growth, because I don't know exactly what we would do with it if we couldn't export it. But as you increase the amount that is produced in the U.S. that is headed to somewhere else, temporarily disrupting it can be a meaningful change. And I think that is actually an interesting one. I'll flip back to you with how specs can and will be, are currently positioned, and maybe again in the future. Spec positioning, in our view, is an interesting topic, but really becomes acutely important for those with true physical length or natural short positions, meaning those commercial participants. What happens for them in these periods when specs are set up to one side of the spectrum? And with that, maybe give us a quick recap of what we see in the world of spec positioning.
Yeah, as you said, it's kind of not interesting until it's interesting. And right now we have some definitely interesting developments where fund managers' spec interest for ICE and NYMEX crude and products combined reached its lowest net level on record last week. So really, this is just looking at futures and options positioning, who's long, who's short, what's the balance there. And when we break that apart into each of these products and Brent and WTI, really we're seeing the biggest skew for Brent, gas oil, and NYMEX products. And so, it's a little bit of an open-ended question, but I think it's worth pointing out. So when you have, long holdings for Brent, for example, you're at the first percentile. Shorts are at the 97th percentile. And really what that means is that you have such skew there where if you have any material catalysts, which in this case, in this environment that we're looking at in September of 24, that's really going to be, in my eyes, something supply side driven. So to me, I'm looking at weather, like, hurricane activity, or I'm looking at geopolitical risk there, where whether, as you just pointed out, only a couple million barrels at stake in the Gulf. But what does that do for sentiment? And really, I think that's the risk, because this is speculators that we're looking at. And so if you have some perceived supply side risk that is material enough to cause the shorts to unwind, then you can get upside price action, rapid volatility, and some of these risks that we look for. I think that's kind of the other side that, as we were talking about before this chat, that there's a little bit of an interesting conversation where WTI, unlike Brent, does not have the same skew for short interest, where you have, shorts are near median, longs are super low. So what does that mean for WTI? And I guess that's kind of maybe, again, an open-ended question, and I'm curious if you have any perspective to add for people listening.
Well, I'll back up for a minute, just so for those that may not have been down the rabbit hole of CFTC data, which is really what we're talking about in large part here. So weekly commitment of traders data that is supplied to the Commodities Futures Trading Commission. So we get this data and it's issued on Fridays for the prior Tuesday. So the numbers that Alex is covering were issued on Friday, September 6th for Friday, September 3rd. Mm-hmm. There will be another data set out this afternoon. And one might imagine that with a significant decline in near-term crude pricing, that the next round of data will show that markets are even shorter, specs are even shorter. Now, the other clarifying point to understand, assuming that many have not been down this rabbit hole, is that when that gets reported, it's not issued in a way that you can see where on the curve that short position lies. It's just one big blob of longs and shorts. And one of the things that's been really interesting for me to learn in recent weeks and just having some conversations with specs is their willingness to reach further out the curve than maybe they have historically. You know, the heyday of commodity funds, probably more so natural gas than crude, you know, the spec interest would have been highly centered in the front, 12, maybe 18 months of commodity curves. And there's an increasing willingness to take positions further and further out. And I think in some ways that fits with the producing communities, not so much the consumers yet, but the producing community's willingness or mandate to seek protection further and further out creates opportunities for specs. So those 2 points need to be understood. It's lag data, and you don't know where on the curve it is. Mm-hmm. The last wrinkle is, to some extent, call it the technical or the algorithm positions that are put on now for those that have a end of the day net zero position, not relevant, but those that will carry a position overnight, day to day, would theoretically also show up in that. And those are very front centric, meaning front 3 months. So, trying to use history as a guide does have some challenges because we may not be in the same world today that we were once upon a time, and how liquidity is placed along the curve. I think we agree that when you're in outer bounds, when, for WTI example, longs are at the lowest level they've been since 2010, or when you've got such asymmetry in Europe where you've got, the Brent longs, essentially at a zero, and the shorts kind of maxed out. Mm-hmm. It does create these moments where you can have some parabolic moves higher. For crude markets, a move higher often doesn't necessarily come with an increase in implied volatility. It can go lower even. Mm-hmm. You just get more and more call selling on the way up, or short vol positions. Unknown how that would unfold. And, I think just to add to your comment about the catalysts that could show up, we've had a nice quiet 2 to 3 weeks here on all things Russia, Ukraine, Gaza, Israel, Iran, Hezbollah, Hamas. That's a nice mouthful. There's a lot that could go on over there that could create that catalyst. And I think for, the real takeaway is, if there is a spec unwind, short covering rally. So what's a short covering rally? Maybe I'm stating the obvious, but we've had enough comments with discussions with clients that did require some unpacking. So short covering rally. It is someone with a sizable short position that has not changed their fundamental view, meaning why they got short in the first place. However, they have squeezed quite a bit of juice out of the orange, and there is something that comes along that says you may begin to lose much of these profits that you've picked up in this position. And that could be some of what we've seen this week. We hit some multi-year lows, and we've bounced off of those, I would say not considerably, but enough. You've got the front of the TI curve flirting with 70 again. and you've got the front of the Brent curve. Spreads are about the same. For example, November Brent's presently trading $72 and November TI is trading 68. So nice, comfortable $4 spread. That's where it wants to settle in. So we have bounced from being down in the lower 60s or the mid 60s for TI and, flirting with a sub 70 level for Brent. And so you can get these big moves in the near term, and you want to look at the rest of the crude complex for what's changing at the same time a short covering rally is going on, assuming that it does. Well, look to products. How is product pricing behaving relative to this exciting crude rally that may show up in the near term? If products aren't keeping pace, it's a big flashing red warning sign. In theory, like Alex pointed out, with the spec positioning in products being quite short as well, products should move along with it. However, if they are not, then that would say that this is crude positions getting paired, closed out, and that could be short-lived. And not to mention, if the product demand has not been there, like we've long had it promised, feels like we've been forecasting markets in general have spent the better part of 2 years now forecasting the sizable increase in global demand, just like for the better part of what feels like 2.5 years now, we've been forecasting the recession. Mm-hmm. So, it doesn't take a whole lot. The market becomes a little lopsided, like Alex is pointing out, and big moves can happen in a short period of time. And it's important not to get caught up in the excitement and be pragmatic and think clearly about what opportunity that creates for many that are long crude, whether it be a seaborne barrel that prices much like Brent, say an LLS, or to a lesser extent, an MEH barrel. If that market is screaming higher, it may not be a lasting situation. It could just be short covering. So what can I add to insulate myself from the next move lower if that demand is still not showing up? And, I think next on our list, and maybe a place to wrap it up today, I'm content to go much longer, but, we'll often flag what's the next piece of news that the market's looking for. And, putting that in the context of catalysts. Well, next week we have on September 17th and 18th, our next US based economic news of note, and that being the Federal Reserve's September meeting. And with that, Alex, maybe I'll kick it back to you for a minute and hear your thoughts on what we think and what the market thinks of the upcoming Fed.
Yeah. So before I jump into that, I think a final word on the spec side, and it's really just cementing what you just pointed out, is that just because it's skewed doesn't mean that it's going to happen. And all of these supply side risks, if they do not appear, then definitely have plenty of room to go lower, as we talked about last week. But getting into the next week's Fed meeting, this week's data was pretty interesting. You have inflation data come out, CPI for August, higher than expectations. We don't need to get into the numbers there, but what we really were looking at is that inflation data, as it did beat expectations, it had a pretty significant day-over-day shift for how markets were positioning for next week's Fed cut. And so when we're looking at Fed funds futures on Wednesday or Tuesday, rather, before the August inflation data hit the wire, we were having a 50 basis point rate cut. Basically, probability for that was 34%, the balance being 25 basis point. That inflation data comes out, that drops to 13% for a 50 basis point cut and 87% for a 25. And as we pointed out on Wednesday, definitely seeing some complications to this outlook for a 25 basis point cut, where you have 3 meetings remaining in the year. You have September 18th, you have November 7th, and you have December 18th. And a cautious 25 basis point cut next week leaves them with November 7th. You have an election right at the beginning of November.
Did you pay attention to that Fed meeting? I'm going to go with that one just was completely unnoticed.
Yeah, and there's a lot of variables that are leaning into that one, and so I think I'll speak for myself. I assign a greater probability of a greater than 25 basis point cut next week, because the risk to labor markets for something that is relatively inconsequential for, cost of borrowing and the benefits to consumers and businesses versus, having a larger cut up front. I think that benefits, economy-focused election in a different way. And so, I think it's interesting to see what happened in the one day since those bets went from 25 basis points at 87%. That's now dropped down to today we're looking at, 57% odds for a 25 basis point. So it just has dropped down to almost 50-50. And so, I don't know if you have any thoughts to expand on that, but
I'll stick with you. If Jerome were to call you and I tomorrow and say, hey, we had a couple members call in sick, you want to sit in on the meeting? I'd be with you. I think there should be a bigger than 25 basis point cut. However, as you pointed out, when we go back to coin flip, I think we are clear that rational thought doesn't always lead to, the next decision. My just follow on with that would be what the read through for energy markets is. In theory, lower rates equal lower borrowing costs equal more supply. I mean, that's kind of more what we've seen historically. The idea that things get cheaper, so we make more, feels like it's translated better to the supply side than the demand side in, say, the past decade. Mm. And then when you look at the US dollar, the dollar index at 101, it had been as high as 105 not that long ago. In theory, like cheaper dollar, lower rates, say, come get more US stuff. Whatever your conversion rate is, or the, ability to borrow, it should be incentivize more flow out. But then it goes right back to this wall. Like, can we, in the energy markets, can we give more? Mm-hmm. How do we get it out there? And so it's possible that we actually just incentivize supply side increases that run into the, how do I move it to where somebody may want it?
Right.
Fun times, I think you pointed out there in a minute, and we'll be pretty careful not to get too close to that very hot iron, but we're inching ever closer to an election too. And what does that mean? I think we're going to start that conversation 40 minutes into this week's discussion.
Yeah. It's definitely a larger topic. And I think, there's a lot of other effects that we're watching for next week's cut, that if it does surprise markets, what happens then? And conversely, if they go inflation cautious with a 25 basis point cut, what do we think about? So we won't get into that now, but I just want to reiterate, we will put out the data deck, all of our visuals for some of the stuff that we talked about today, hopefully help kind of connect some of the dots for listeners when that gets a little into the weeds. So you'll find that in the show notes. But again, Zane, it was a fun week chatting with you.
Thanks. Good being with you, Alex. Look forward to next week.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.